Traders, welcome to Options Education Series Course 1, Foundation. The goal of this course is to demystify the concept of options and to help you gain a solid understanding of options theory. When it comes to trading options, it is of the utmost importance that you learn and understand how options are priced and how they behave. And that's precisely the goal of this foundation course. Perhaps the least intimidating way to introduce options to you is to draw upon real-life examples. So I've chosen two examples that at least most of you should be familiar with. Example 1 deals with a coupon offering a couple of bucks off the regular price of a pizza. And example 2 deals with auto insurance. Doesn't get any more familiar than that. Example 1, a pizza coupon. Let's say that the price of a large one-item pizza at Vic's restaurant is normally $15. Vic's is offering a coupon deal on a large one-item pizza for $12.50. From now on, the product itself will be referred to as the underlying, and the deal price, the price specified in the coupon, will be referred to as the strike price or simply the strike. The coupon is a contract. It has an expiration date. In this case, it's stated on that coupon. It's August 31st, 2016. The coupon is a contract. It obligates Vic's to sell you a large one-item pizza for the specified strike anytime between now and the expiration. You have the choice to use or not to use the coupon between now and the expiration. The value of the coupon is the difference between the regular price of the pizza and the deal price advertised in the coupon. In this case, it's $15 minus $12.50 equals $2.50. This value will be referred to as the intrinsic value of the coupon. If the cost of pizza ingredients, say, were to suddenly increase before the expiration date, forcing Vic's to raise the price of the pizza by $2, Vic's is still obligated to honor the coupon. But the coupon's intrinsic value now has automatically increased by $2 because the pizza is now up to $17 regularly, but the coupon still entitles you to buy it for $12.50. Therefore, the intrinsic value of the coupon has risen from $2.50 to $4.50. Let's apply some of the options lingo to this previous example. And so the pizza coupon becomes a call contract or simply a call. The writer and seller of the call is Vic's. You are the buyer of the call. In this particular case, you paid $0 for it. The call obligates the writer, in this case Vic's restaurant, to sell the underlying instrument, or simply the underlying. Sometimes it's also referred to as the underlying product. In our case, it's the pizza, of course. So Vic's, the writer of the call, is obligated to sell the underlying to the buyer for the specified strike price, the deal price, simply referred to as the strike, and is obligated to do so by no later than the specified expiration date, which is simply referred to as expiration. The buyer, the holder of the call, the coupon, you're the holder of the coupon. You have the right, but you're not obligated to exercise the call. In other words, to take advantage of the offered deal before it expires. Now we can take all the terms of this contract and condense them into a single line. The product in question is the underlying, which is the large one-item pizza. This coupon has an expiration date. It's valid up until August 31st, 2016. If you were to take advantage of the offer, you're entitled to buy the underlying for the specified strike of $12.50. And the type of contract we're dealing with here is a call. Let's go ahead and apply some of what we've learned so far to an actual stock. Let's envision a scenario using shares of Apple instead of the large one-item pizza. Say it's November 2016, and Apple shares are currently trading at $110 per share. A trader named Vic, whom we'll refer to from now on as Trader Vic, he owns 100 shares of Apple. He writes a call contract in which he promises to sell 100 shares of Apple for $110 per share by no later than January 20th, 2017. Now let's condense all that information, all the terms of the call contract, into a single line. The underlying is obviously Apple. The expiration date of the contract is January 20th, 2017. And the advertised price is $110 per share. That's the strike price. Obviously, the contract is a call. Now, in every transaction, there are two parties. There's a seller and there's a buyer. Trader Vic is the seller of the contract. He's looking for a buyer. You happen to be bullish on Apple. You expect it to reach as high as $125 per share in the next 2 or 3 months. So you decide to buy Vic's call for an agreed upon price of $595. A few weeks go by. It turns out you were right. The price of Apple does manage to reach your target price of $125 per share, and the call contract has yet to expire. It's still valid. And so you go ahead and you exercise your right to call away Vic's 100 shares, meaning to buy them for $110 per share per the terms of the contract. Vic's, of course, is obligated to sell them to you. He's the writer of the contract. He's obligated to honor the contract. To book your profit, you turn around and you sell those 100 shares for the ongoing market price of $125 per share. So how much money have you made in this transaction? You bought the 100 shares for $110 per share, and you sold them for $125 per share. That's a $15 profit per share times 100, that's $1,500. Subtract from that the cost of the contract, the premium that you paid, $595. The net profit, therefore, is $1,500 minus $595. Now on to the second real-life example, the one dealing with the auto insurance policy. My auto insurance policy costs me $490 every 6 months. That's the premium. My current policy expires on October 3rd, 2016. That's the expiration. The policy is a binding contract obligating the insurance company to cover the costs of any damages or injuries resulting from an accident. The collision coverage included in the policy pays out to replace my car in case it is totaled by no later than the expiration date of the policy. In other words, the insurer is obligated to buy my car should it be totaled for its published Blue Book value. So we're dealing with a product. What is it? The car. That's the underlying. The contract states that I can sell that car should it ever get totaled back to the insurance company for the Blue Book value of the car. That's the advertised price, the strike. I have the right to sell, in case of an accident, the totaled car, the underlying, to the insurance company for the strike amount. Now, in case no accidents occur on or prior to the expiration date, the insurance company gets to profit from the collected premium. Let's apply some of the options lingo to the example at hand. In this case, the insurance policy is a put contract, or simply a put. Why is it a put and not a call? In the case of the call, I bought something that is appreciated in value at a bargain price. In the case of the put, I got rid of something that has depreciated in value due to an accident at a bargain price, the Blue Book value. The writer and seller of the put is obviously the insurance company. I am the buyer of the put. I bought it for a premium of $490. And this put will remain valid and in effect until the expiration date of October 3rd, 2016. The put gives me the right to sell and hence obligates the insurance company to buy the underlying for its Blue Book value, in other words, the strike, should an accident occur and the car get totaled by no later than the expiration date. Now let's go ahead and condense all this information, all the terms of the contract, into a single line. The underlying is the vehicle, in this case the 2016 Jeep Grand Cherokee. The expiration date of the contract is October 3rd, 2016. The strike, the agreed upon value of the car should it ever be replaced, is more or less the Blue Book value. And of course, the type of contract we're dealing with here is a put. Let's go ahead and apply what we've learned so far to an actual stock instead of the insured vehicle. Let's envision a scenario using Apple shares, which are currently trading at $110 a share. You buy 100 shares of Apple, expecting it to reach as high as $125 a share by January 2017. Say 5 months from now. To protect your investment, you buy a put for a premium of $600. Now, this is no different than when you bought a put from the insurance company to protect yourself and your car against any unforeseen accidents. Now, what would constitute an accident in the case of Apple? Well, a piece of bad news could cause its price to drop significantly. That's the type of accident that you're looking to protect against by buying the put. This put has a strike of $110 and an expiration of January 20th, 2017. If by expiration the price of Apple shares drops significantly, say to $76 a share, the seller of the put, the person or the party who sold the put to you, is obligated to buy your 100 shares for the specified strike of $110. Now, how did buying the put protect you exactly? Well, the stock dropped from $110 a share down to $76 a share. That's a 34-point drop. You own 100 shares. You would have incurred a $3,400 loss had you not been able to invoke your right to sell your shares for $110. You came out unscathed. For that, you had to pay $600. That's a lot better than having to incur a $3,400 loss. This is no different than when you bought the insurance on your car, the policy to protect you against accidents. Now, what would happen to the premium should no accident occur? Well, the seller books the premium as profit, just like the insurance company booked your premium as profit. They didn't have to pay for any accident because no accident took place. Options characteristics. From the previous two examples, we already know the following. An option is a contract to buy or sell a specific product. In the case of the stock market, this product is a financial product, such as a stock or an exchange-traded fund. The product is referred to as the underlying security, the underlying instrument, or simply the underlying. An option can either be a call or a put. The premium is the price paid by the contract buyer to the seller. An option contract represents 100 shares of stock of the underlying, which could be the stock or the ETF. And an option is a very precise contract. It sets a strike and an expiration. You can take all this information about a contract, all the terms of the contract, and condense them all into a single line like we've done here. Benefits and risks. Before we delve into the more intricate aspects of options, it's important that we highlight the benefits and risks in order to form an understanding of what options are and are not, their advantages and disadvantages. For starters, we know that, for example, a call option is an alternative to buying actual shares of a stock. Remember when, in the example, you bought a call with a $110 strike, you were expecting Apple to run up to $125 a share in the next 2 months. What happened? It certainly did, and you were able to capitalize on that move without having to buy actual shares of stock. We also know that put options can be an effective risk management tool. Again, recall when I bought a put to protect my 100 shares of Apple against any potential accident, it was similar to the case of an auto insurance policy. Third, options trading involves strategies that you must learn before risking any serious money. These strategies will help you understand your risk exposure and your potential reward. Option strategies employed by traders and investors usually have a limited risk and a limited reward potential. We will explore strategies in depth in course number 2. Fourth, options trading generally requires less capital. For example, buying one call option costs much less money than buying 100 shares of stock. We've already seen that in the previous examples. But hey, what's the harm in another example? Let's say that Apple's price per share at the time of purchase was $106.94. I can either buy one call option, say the January 20th, 2017 call with a strike of $105 and pay a premium of $515. This, of course, gives me the right to buy 100 shares of Apple at $105 per share by January 20th, 2017. The alternative would be to buy the shares outright. I can buy 100 shares and pay a total of $10,694. So it's either buy a call for $515, giving me control over 100 shares between now and January 20th, 2017, or just simply go out to the market and buy the shares. Which approach is better? Which one is more advantageous? To buy a call option and pay $515, or to buy 100 shares of stock and pay $10,694? The answer is there is no right answer. It all depends on your timing, how much homework you've done, and of course a little bit of luck. Say you bought the call option for $515 and suddenly the stock suffers a setback. It falls below $105 a share, never to recover by January 20th, 2017. What would happen to your call option by then? It would expire worthless. However, if you had bought 100 shares of stock, you could withstand the setback, wait it out until the shares recover. Eventually, you could break even go on to realize a profit. Maybe the shares are destined to go up to $125, but maybe not by January 20th. Therefore, buying calls and puts is a timing proposition. You have to be right not only on direction, but on the time frame. Buying 100 shares of stock, there is no time constraint. I can hold on to my shares until they eventually recover and go on to make me money. Here, of course, we're shining a bright light on this example. We're assuming that by January 20th, 2017, the stock has risen up to $125 a share. The $105 call is now worth $2,000. 105, 125, $20 difference. 20 times 100 shares, that's $2,000. That's how much your call is worth at expiration. How much profit have you realized? $2,000 minus your initial investment of $515. That's $1,495 in profit. On the other hand, had you bought 100 shares of stock, you would have turned around and sold them back to the market at $12,500. 125 a share times 100 share, that's $12,500. minus your initial investment of $10,694, and that nets you a profit of $1,806. So let me ask again, what would you rather do? Spend $515 on a call option and stand to make a profit of $1,495, or spend $10,695 on 100 shares of stock and make a profit of $1,806? Now, earlier, with respect to the call option, I might have drawn a gloomy picture. I said that the call option has a limited time window to realize a profit. Meanwhile, the shares of stock, they don't have a time constraint. If the stock were to suffer a small setback, it can always come back, recover, break even go on to make a profit. But what if those shares were to suffer a 50% haircut? Now your $10,694 investment is reduced to a little over $5,000. Now, of course, you could wait it out a year or two, maybe less, and eventually the stock could recover and go on to make a profit. But just imagine the psychological impact of losing, even though temporarily, $5,000 versus betting $515 on a trade that never panned out. Okay? You could always look for another opportunity and recoup the $515 loss in a trade or two, and in much less time that it would take for the shares of this particular stock here, we're talking about Apple, for it to recover. And you know what happened in 2012. It suffered a 50% haircut and took 2 years for it to recover and go on to make a new high. So it's up to you. You have to know the advantages and the disadvantages of doing one or the other. Wow, we really spent quite a bit of time on this example. Let's go on with our list of benefits and risks. Options aren't casino chips to be squandered by taking a stab at this or that stock. They can be weapons of mass destruction. You could blow one account after the other by betting and trading like a deer in the headlights. Options, unlike what you hear on TV and radio and all those junk emails that you get, options aren't a get-rich-quick scheme. If someone told you that they got a secret, why are they sharing it with you? They should go on to become millionaires and billionaires. Okay? There is no quick way to make money with options. There's a quick way to lose money and go bankrupt with options. As an options trader, you already know by now that the entire premium that you pay is at risk. Timing has to be impeccable. Your homework has to be done right. And needless to say, time is not on the side of options buyers because the clock is ticking. Unlike a particular stock that can lose 70% of its value in a matter of weeks, only to quadruple a year later, an option has a limited time window to realize a profit. We've already seen that in the previous example. So allow me to stay on this topic for a little while longer because I'm about to show you graphically how the option premium, the price of your option, is adversely impacted by deterioration in the price of the stock and by the passage of time. So here again, example one, you bought shares. You buy shares of Apple at $100 a share, only to suffer a severe drawback in just a few short months. As painful as it feels, you decide to wait it out. In the next 2 years, the stock manages a full recovery and goes on to set a new all-time high of $136. Not only have you recouped your losses, but you've realized a nice profit. Your patience paid off. You came out on the winning side despite your initial bad timing, because you bought at the top, right? Now, in example 2, imagine having bought call options instead of shares of Apple. You chose the call option having a $100 strike and expiring 12 months later. You bought them at the top of the market, the day Apple peaked. I think it was September 21st, 2012. You gave yourself ample time, a 12 months time window. The stock was trading around $100 a share, and you chose the $100 strike. Apple has been rising. There's no indication it was going to stop. You figured that if it were to move up another 15 or 20 points in the next year or so, you stand to triple your investment. But things are almost never this easy, are they? Instead of continuing to rise like you had foreseen, the stock instead suffers a severe haircut of nearly 50% in the next 6 months. During this 6 months period, the calls are practically reduced to rubble, complete premium erosion. There's still 6 months left, though, until expiration. Your calls have a strike of $100. If the stock doesn't stage a complete recovery and manage to rise above $100 before expiration, your calls on expiration day would be worth zero. But that never happened. Never happened. It took longer than that for the stock to recover. Therefore, even though you've given yourself 12 months to realize a profit, your timing was bad, and the calls ended up expiring worthless. Time was not on your side in this particular case. To illustrate the effects of price and time on the value of an option, meaning the price of an option or the option premium, I'm going to rely on what is known as an options pricing calculator. Of course, we haven't yet discussed how options are priced or what the Black-Scholes model is. We will tackle this exciting topic a few slides later. However, I need you for now to trust what this calculator is saying. Here, I entered the price of Apple, the strike price of my call, the stock's volatility measure, the interest rate of a U.S. Treasury bill, the stock's dividend, and the expiration date of my call option. I'm assuming today is September 21st, 2012, and my option expires exactly a year from now. Per the model, according to the calculator, the option is worth $7.09. The x-axis represents the price of the underlying. Apple's stock price is the x-axis. On September 21st, 2012, the stock is at $100 and my option is worth $7.09. Now I want you to pretend to freeze the clock. Time is no longer an issue. The clock is not ticking, a frozen time. And let's imagine for a moment what might happen if Apple shares were to drop to $95, $90, even $85. The green curve in the top chart plots the price of the option against the deteriorating price of the stock. So you can see that what was a $7 option is now a $2 option as a result of the stock falling by 15 points. Now, let's imagine a different scenario. Let's pretend to freeze Apple's price at $100 a share for weeks and months. And then let's observe how the passage of time is like a burning flame that eats away at the price of the option. The green curve in the bottom chart plots the price of the option versus the passage of time. For example, with 260 days left until expiration, the price of the option has already dropped by $1. Why? Because the stock hasn't moved. It hasn't moved to counter the effect of time decay. The stock has done nothing during those 100 days. The price of the stock hasn't moved. 100 days ago, it was $100, and 100 days later, it's still $100. What has happened, though, is time has passed. And the passage of time, I said, is like a burning flame. It has taken a full dollar toll on the price of the option. It has dropped from about $7 to about $6, as you can see in the chart. What does this example convey? What does this example convey? It conveys a very important point. Time is not on the side of the options buyer. To combat the negative effect of time on the premium, the price of the underlying stock must move in the right direction. If you buy a call, the stock has to rise. If you buy a put, the stock has to drop. And it has to do so fast enough to combat the negative effects of time. Now, what do I mean by fast enough? I said the price of the stock must move in your direction, and not just in your direction, but fast enough in your direction. Otherwise, the call option that you bought could be in trouble. To illustrate, let's go back to the day when you bought the option. It was September 21st, 2012. The stock on that day was trading at $100. You chose to buy the $100 strike call at a price of $7.09 per share. So you really paid $709 since the call represents 100 shares of stock. And this option, of course, expires a year later on September 20th, 2013. So let's go ahead and fast forward to that date. Today is September 20th, 2013. It's expiration day. And looking back over the last 12 months, the stock hasn't had a stellar year. It has managed to eke out a 2% gain, so it's trading at $102, but certainly not as high as was expected. For you to break even on expiration day, the stock had better be over $107. But the stock is at $102. Your call option has dropped from $709 to $200. Why? Think about it this way. If you were to exercise your $100 strike call, you'd be able to call the stock away at $100 and sell it in the market at $102. That's a $2 gain per share. So Okay, you brought in $200, but you paid $709 for the call option a year ago. You've actually lost $509 because time was not on your side. The price of the stock did not move fast enough and high enough during those 12 months for you to realize a decent profit. Okay, had it moved by 10%, the stock would have been at $110 on expiration day, and your call option would have been worth $10. On a final note, imagine what would have happened had you chosen to buy the put option as opposed to the call option. You would have paid $8.96 and would have realized a profit of 400% 6 months later.